Is discretionary trading a path to consistent profits for the average person? Well, in this episode of Systematic Shenanigans, hosted by myself, Manir, and also Pedma, we dive into the realities of trading psychology and strategy development. We are both systematic traders, while I am primarily more algorithmic than Pedma, and Pedma primarily focuses on crypto markets, while I mostly concentrate on futures and equities. With our combined decade plus of trading experience, we've weathered multiple market cycles, and in this episode, we explore the most recent market sell-off that has been one of the worst months for SPY in recent times. We'll examine how systematic and discretionary approaches perform during these challenges, as well as some practical wisdom for growing small accounts. This is just a conversation between two real traders sharing honest insights about the market challenges and opportunities. Let's dive straight into this episode. All right, well, I think we should start off with just the general market. It's been a sell-off for the past, week. I think it's been the worst month for SPY in quite a long time. I think we're like down, give or take 9 to 10%. We had a small bounce today. As time of recording this is the 14th of March, and some things have started to rebound, but you never know. Over the weekend, it could completely collapse again. But yeah, what are your views on it at the moment, Pedma?
Yeah, it has been a crazy few weeks, right? A lot of stuff happening, like headlines, more macro stuff that I'm not going to pretend that I understand. But markets have been crazy. Like Bitcoin is down, was down to 30% to the lows. Others, that is all the other altcoins, were down like almost 60%, which is
Crazy.
a lot. Like 60% is a big drawdown. So there's a lot of that type of behavior, weakness in the market right now.
Yeah, no, totally. Well, I guess on our actual first note of this kind of podcast for this week, at least my notes was, do you think the average person off the street can trade profitably with discretion? I put it out on Twitter. I didn't personally believe so, but I wanted to hear a bit of your thoughts because obviously it sort of ties into turtle traders, but they were giving the system. So it's more around the conversation that, do you think with just pure, human intuition, not much experience, do you think someone can be profitable trading?
No, I don't think so. Because you might get lucky. Like if you put 1,000 games of coin flips, someone will make all the money, right? Someone will win almost all the games, and that's just luck. That happens, is a factor in markets, but someone measuring through skill, I don't believe so. I think that the turtles had a great guidance at the time. The markets were amazing for traders back then. All the conditions lined up. They had that mentor, and they made it up for that. But someone coming into the markets right now, discretionarily, and trying to trade, it's just against all human nature. I don't think that they can handle it.
Yeah, I would totally agree. I like it. It almost seems like a comical kind of like question when I ask it now, because obviously we have a lot of market experience. But when I think back, like in my first year, I sort of thought it was possible. I didn't think it was a ridiculous kind of question or thing to do, if that makes sense. Especially from a lot of things you portray on YouTube, where people say, "Oh, it's just like your intuition of, is the market going to go up or down, and that's how you trade, and like somehow you can be profitable consistently over multiple years." I think fundamentally it all is with a system. I do think as you get more experience, you can have way better intuition. There's some amazing discretionary traders I know, and they've built it up over many years. But I don't think you could take someone off the street and for them to actually be fully profitable. So that's personally at least why I prefer systematic trading compared to really anything with discretion. Do you think systematic trading is easier to become profitable faster compared to discretion? Because that's sort of what I think. I at least in my opinion, I feel like it's easier to get to profitability with systematic trading or like algo trading, but your ceiling is going to be probably lower than a discretionary trader. That's at least just my thoughts. What do you think?
Maybe your views when you came into the market, and I'm the same, because our stories are very similar. We were like gamers. You were even more professional than myself. So your mindset was always, okay, if I go to a game and trading, we can equate it to a game, like right, that we are competing against other people. If you come to this game and you think that perhaps you can beat it like other game, maybe that's our mentality. Because I thought the same like you. Like in a few months, I would be a profitable trader. I just go to the market, trade against others, and I'll figure it out. But it doesn't work like that.
Yeah, no, 100%.
In terms of your second question on the systematic, if it's easier, that's a good question. I think that your chances increase a bit, but I think it's mostly the same, in my opinion. If you don't have a guidance, if you don't have someone telling you what to do and what not to do, because okay, in discretionary trading, you'll most certainly lose money if you don't know anything. In systematic trading, you could get lucky and end up with a good system and find yourself with a good system on your hands, and you don't have a clue that it is a good system, but you got lucky, and you might make money if you follow it correctly. But in terms of, if I would have to bet on each one, I would say they probably have the same probabilities, because there's so much noise out there, even in systematic trader, like bad systems, things that make no sense. It's more likely that you'll end up with a bad system, even though you might think it is good because of your backtest or whatever. So to me, it's the same, in my opinion.
That's fair. I guess, yeah, a lot of it does come down to guidance. I don't know. I'm still 50-50 on it. I sometimes think about it that, because obviously we probably both get asked the question, or at least I do DMs a lot, is like, how would you start again? Or what would you do starting?
Oh,
and at least for me, sorry?
Yeah, I would do systematic. There's no doubt about that. I'm just saying that the marginal difference of like someone coming in knowing nothing, let's say knows nothing, no intuition, no guidance. Two traders, one trades discretionarily and one trades systematically. I think that maybe the systematic trader has a better chances of getting there faster, but both will do the same mistakes, in my opinion.
I guess then we fundamentally agree, because like I'm not saying they won't make mistakes or anything like that. I just feel like if you start systematic, you will probably get to at least some level of profitability. I'm not saying like crazy profitability or anything like that, but you'll get to some of that faster than if you were going to do discretion. Just because I think there's more of a process to follow with systematic trading compared to just discretion, right? With systematic trading, once obviously you make some mistakes and you start learning, and whether you get guidance or not, or if you just start reading books, etc., if you start like a very basic trend following model and you actually stuck to it, you probably would get to profitability faster than a trader trying to do some discretionary intuition system, if that makes sense.
Yeah, completely agree. It's just that initial intuition about what is a good like system, because they'll probably land on a bunch of stuff that doesn't make sense and doesn't work. It's like you said, the systematic the person that starts systematically and starts testing data and looking at data and stuff like that will probably get there faster. I would bet on that, but I would also say that it's not easier. It's just more structured, let's say, and that allows you to get there faster.
Yeah, completely agree. And then for the kind of second note, this was actually a question from our previous podcast. Someone asked really about the general idea was like, how do we use fundamentals versus technicals? Do we prefer one, etc.? At least in my experience, I view fundamentals and technicals quite similar. Overall, I just view them as parameters. The only difference is on fundamentals, you can have sort of like events, I guess you would say, like earnings events or things like that, right? Where you can more have a whole trading system just around that one fundamental event, like, earnings release, etc. There's a lot of strategies around earnings compared to technicals. But both of them, I treat them quite the same. I will say, if you're actually asking, what do I use more of, it's definitely going to be technicals. I don't use fundamentals as much, but I think that's because I don't really venture into large caps. If I was mainly a large cap trader, then I think you'd use fundamentals quite a lot. Some people use a decent amount of fundamentals in small caps, like flow, institutional ownership, a lot of other stuff. I do see the value in it. I know some great fundamental small cap traders, at least just for my own personal systematic trading. I don't use them that much, just because one key thing with fundamentals, I guess, compared to technicals, is getting accurate historical data of fundamentals is a lot more difficult than just loading up a historical, indicator, for example. And to actually verify it as well, that's a whole nother problem as well. So at least for me, that's how I treat it. How do you treat it in crypto? Do you actually use any fundamentals at all?
No. I have one position that I'm based all my thesis and my risk on fundamentals, right? But it's not like I have a system for it. It's just like kind of guessing. In terms of fundamentals, I would say that to me it's like any other signal. It's like, how predictive is that of future returns, and how much edge does it add to your system? if you can find reliable data for it and it does really help you with it, I would say that it's like you said, like in equities, it's probably more important because you have a lot of dynamics that affect price, and a lot of them are around what is the company actually worth and stuff like that. So I think it's a good, if you can find, it's like I say, if you can find something that is predictive of future returns, great. It's just like any other signal. Personally, I'm in crypto and there's not many fundamentals around, so I just trade technicals.
My last topic that I have noted down is around the stress tests of black swans every 2 years. And I think this is sort of applicable, sort of, I guess, to today because we're having like a drawdown month, or at least everyone's very overreacting to it. Is that seasonality is a really big thing. I think it applies to pretty much all markets, and it's quite consistent that most markets every 2 years, give or take, maybe 2 to 3, will have some sort of black swan event or unseen event happen. And that will often cause you to really have your strategies tested. And I think this is one thing I see from newer traders, especially if I'm ever working with anyone on it, is that they will hyper optimize to get the best returns in the best market regimes, but they will often not pay as much attention to just protecting their downside on the worst case events. And at least in how I build the models, that's the first thing I'm really looking for, because you know they're going to happen. And if you're going to be trading for the next 5-10 years, if it's going to be an actual career, you're going to fall into one of those events. It's just, it's going to come up. Everyone thinks they're never going to happen, but it's very consistent. If you look back in time, it's about every 2 to 3 years that one will occur. So at least for me, I think the main point is try and focus on protecting for those black swan events if you are planning to stay around for the long term, compared to just trying to high parameterize for the perfect regimes like we've had, like I guess last year, give or take, or the year before. But what's your sort of thoughts? Do you do any sort of that testing at all, Padma?
Oh yeah, of course. I care more about the periods I'm losing money than the ones that I'm making, for sure. Good portfolio management, in my opinion, is more about risk control than maximizing profit. That's why I would say good traders and professionals look at stuff like Sharpe ratio, the skew of the model, stuff like that, to really understand the risk profile. They always talk about risk profile, never return profile. Or when they talk about return profile, it's not as emphasized. Returns are like, you care, right? You want to have something that produces good returns, but what is the purpose of having something that produced you 100% and the next year you lose 90% of it, right? You can't handle that type of volatility. You might be able to handle it looking at the backtest, but you won't be able to handle it with significant cash behind it. That's just a reality. So I would highly focus on getting as much data as you can for as many bad periods as you can, and using realistic assessments of history. Yeah.
Did you, just because maybe it'll be useful for people to hear, did you have a point in time where that clicked for you? Because at least I remember beginning year, maybe 3 years, maybe 2, I guess in my trading journey, I was more hyper focused on returns. That's, you know, what everything you want to focus on because you have a small account, you're really trying to get those returns. Do you have a moment where it kind of clicked that you need to focus as much or even more actually on the downside compared to returns?
To be honest with you, probably not until probably year 4 or 5, to be honest with you. Wow. Because all that I can remember from that time, even when I started trading large caps, even when I started trading crypto in 2021, I was still very much focused on maximizing as much as I could the upside. And I ate a lot of volatility and drawdowns because of that. And yeah, and it all stems from the reason that I didn't have a big account to work with. And at the time I had to take a lot of risk and I wanted to grow. I wanted to go to these figures and those figures and see other traders do it. And I mean, that's fine if you are trying to grow capital. You'll probably just be mindful that you're going to eat a lot of volatility and drawdowns and probably blow your account if you are doing something that is not that sensible. But when you grow some capital, your main concern, you'll start shifting naturally towards, okay, I have this capital that I want to protect. I want to grow it as well, but now I want to protect it. So I'm going to start looking at stuff like more sensible stuff, like what's the volatility profile of the strategy, what's the skew, what's the Sharpe ratio, stuff like that.
Yeah, at least for me, it wasn't a singular event for me, but I think it was that I got basically metaphorically kicked by the market like at least 4 to 5 times trading small caps. And if anyone's trading small caps that's listening, you will know the volatility in small caps can just be ridiculous, like with halts and just very unexpected moves. And I took some decent losses. While I was compounding my account very well, all of a sudden I'd lose, I don't know, 20%, 30%. Obviously, I'm not saying that was good trading, but it was, my earlier years, and that's just what it was. And then from there, after that many times, I just one day I kind of woke up and it sort of clicked. And I was just like, okay, like I can't take this anymore. If I keep on having moments like this where my account, drops by 20% because I do one bad thing and I'm too focused on returns or trying to optimize for those, then I just really became obsessed with protecting downside. And I think that's kind of what shaped me into the trader I am today, because I am way more focused on like a consistent equity curve than returns. And I think it's somewhat to my downside, because I feel like I could have compounded a lot faster nowadays if I was a bit more, I guess, happy to take on some extra risk. But it just is what it is. That's kind of how I formed Overtraded because of it. But yeah, feel free to go over to your notes, because I think you got one great topic of automation versus manual.
Before we go to the next, actually, this is an interesting concept. What do you think? But there's an unspoken, how can I say, like an unspoken truth here as well, because we've all seen those stories. And when I talk about this, it's like the real traders, right? And I'm not saying about those stories that you see from YouTube influencers. I'm saying real traders that took like 5,000. Tim Grittani, for example, they took $5,000 to multiple millions, and those guys are not like, they're not stabilizing for volatility. They're not trading at 20 or 30% annualized volatility. They are running mad numbers.
Yeah.
So there's a case to be made there. What do you think?
I think it's very hard to, when we because we sometimes talk about this topic a lot, and a lot of the times it just comes down to survivorship bias, in my opinion. It's very difficult because, like, yeah, you do have those stories, but even just like, I'll tell you one that actually did kind of hit home on Twitter, because I thought it was just insane, and hopefully it's maybe true. Well, I don't know if I hope it's true or not, but anyway, the story was that one guy was up, I think he was like 750K in crypto because he was on leveraged positions, and because of this recent retracement, he's down to like 30K. And I'm like, how? I couldn't stomach that on, like, I just never could. It just, I don't know, at least for me personally, that just couldn't happen. Whereas for some people, like we're sort of describing, like also like Short Bear and Lucas is a decent example of this. Like, he compounded like crazy over 2020. And we've talked about it many times. I just don't think I could have done that. Not at that level anyway, because he kept on growing even when he was at 1 million. And for most traders, I think if you hit 1 million in profits, you'll be like, okay, I'm going to take a step back now, maybe buy a house, or go into some lower risk things. But no, he kept on compounding, and that's what's obviously made him one of the greats, at least in my opinion, or at least of the recent times. Yeah, I don't know how to really end off that point. It's just more that for some people it will work, but there's going to be a lot of people that doesn't work for.
It's like I don't want to give like false hopes, yet at the same time, I know that someone like with $1,000 account or something like that ain't growing that, trading at 20 or 30% annualized volatility. I don't think he's growing that. Like, I don't think that person is growing that at all. But if they are going to try to grow it, it ain't at protecting downside. Let me step back. It's not taking a massive risk. I'm not saying to go get a bunch of leverage. I'm saying that we have to be willing to take additional risk that others with larger accounts aren't willing to take, because that's just the nature of it. So it's an interesting topic.
I would also say I am more of the approach now, looking back, that I don't, people may not like this, but I don't think it's a good approach to try and grow a small account that aggressively if you're thinking long term. We've talked about it a couple of times, but I really do think the most sound model, I guess, or at least in my head, would be have a solid small account, learn all your lessons, keep on growing, and then just add external capital to it. I feel like that's the most sustainable model. But yeah, you can, like sort of we've done, like you can take a small amount of capital and compound it very hard, but you have to get lucky.
Yeah, for sure. I think that this goes really well with my second topic, actually. So we could start on that. Like, sure. My second topic is around what should a trader do that hasn't made money yet. Like someone that just started out that hasn't made money yet, and let's add the caveat that they don't have a lot of capital. So we can continue this conversation on that topic, I guess.
Okay. Sure.
Yeah. So my opinion on this, and continuing with the conversation, is like, okay, you have to structure. I actually wrote an article on this, and you have to structure your trading. I'm going to talk like about what I did and what worked for me. This is not a story for everyone. So it's just what I did. I don't know anything else other than what I did. Basically, what I did was I got a reasonably, like, not low risk, but a reasonable, sensible model, trend following in crypto, and I applied it. I knew that it would work. There's a lot of data in support of like trend and momentum strategies. It goes back decades in equities. There's a ton of evidence that that type of strategy should continue to work. The issue is it's not a strategy that is going to make you tons of money. Maybe if you run it at very high vol in crypto, you are looking at probably 80% or 100% annualized in crypto. And it's, when you say annualized, it's not like every year. It's an average over many years, right? So, but even that, if you are running like a $10,000 account, let's say you make 100%, you still made only $10,000. So it won't make you like it won't be one of those stories that will turn a small account into millions. Okay, but it's a strategy that you can run, and that you know that should continue to work, and that it keeps some certain peace of mind because you know that you have something there. And that's where I took money from my job, from my old job, and I applied it there because I knew it was not safe again, but it was safer that I knew it continued to work. Okay, that's my like base is what I look at. Then I would have a second portion where there I would test a bunch of stuff that I got my mind on. I saw this protocol that had this type of strategy that I could run. I would go into those protocols, and I would apply. I would throw a bunch of capital at it. I would throw capital there and here and in that type of strategy and the other, and yeah, and over time that actually helped me a lot. But it wasn't my main trading, if that makes sense. That's how I would structure it. Make something your base, and then use some sort of smaller capital to more risky stuff, but that maybe could give you something else, if that makes sense.
It's really difficult to kind of put it down into one pathway. But what I'd say is, looking back now, I think the way you grew your account was sort of the right way in some aspects, because I guess I sort of did it in small caps, because the first point I would say is, if you have a small account, you need to first know your risk limits, right? Like, what are you trying to grow it to, and in what sort of time frame? If you want to be really risk taking, and you want to try and grow it as fast as possible, but you're happy with losing it all, then what I would do is go for one of the very volatile areas. So as you kind of mentioned, crypto, I'd also mention maybe small caps. You could also do options, but I don't have much experience with options. And in small caps, it's, if you start with a $5,000 account, most of these brokerages will give you about 4 leverage, give or take, about 4 times. And you can grow that quite fast if you are lucky with the sequencing of your trades. Because shorting small caps, it's very cyclical. So you'll have maybe a month, 2 months of times where most things will just fade, and you can get very lucky with it. And then there will be one time where something will not fade and it will move 200% in a day, and it will blow out most accounts that are trying that sort of strategy. But it is necessarily still a strategy technically. For growing a very small account. So if I was risk on, I had $5,000. Let's see if I could turn it into a lot more. That's probably what I'd do, but I'm happy to lose it all. If I didn't want to lose it all and I wanted to do a slow and steady sort of approach, I would do more of a classic portfolio build. So sort of what you do, and I guess a mixture of what I do, is build out a collection of normal strategies, so trend following, mean reversion, maybe a couple others, core strategy types, mainly risk premiums, and then build with external capital alongside it. And especially if I'm just starting out, I would be testing a lot of different ideas with a small amount of capital on the side, sort of like you did with, like, let's say, I will say the percentage has to be very kind of carefully calculated, because every dollar when you have a small account matters. It matters a lot more than when you have a bigger account. So I would probably do no more than 10% of your account size to be testing on small ideas or exponential ideas. You can test those there, and the rest will just be your core foundation, sort of what you mentioned. But I think those are the two paths, because I do know some traders. Like, I've had a friend of mine that wanted to get into trading, and he was like, all right, I have 3,000 and I'm happy to lose it all. And I was like, there's technically two paths you could do with that, but it's up to you. It really has to be how much you're willing to lose on that. And if you want it to be more of a lucky shot of sequences or an actual career. If you want it to be a career, then yeah, you have to do the foundational approach, in my opinion.
Yeah. I completely agree. I think you need to establish yourself something solid first and something that you can run and that makes money today. I really like that approach. Like, you know that momentum, mean reversion, trend, those should make money, even though they are very noisy, but they should make money. Okay,
Yeah.
that's your base. And then you extrapolate to something that is riskier, but that may yield extraordinary returns as well, and I wouldn't neglect those. I myself run my trend model, but most of the times I'm just throwing capital at stuff. Even, yeah, we talked about last week, like me arbitraging like funding rates between new decentralized exchanges, like new protocols with low liquidity. Like, no one is trading there generally. So they have a lot of these rates that are very high, very inflated compared to the market. And I am willing to take the risk of the platform, and I go there and I collect funding on them. And that's what I'm doing. And that's a nice stream of income there. So just test a bunch of stuff. That's what I say. But remember yourself to always have your base. Establish your base first.
Yeah. I'd also say one thing like Twitter is very good at doing is losing the value of a dollar, basically. Because you see such insane numbers on Twitter, and especially in the trading space, you see such insane numbers. Like, it's very realistic, at least in my opinion. I know this will be weird for like long-term investors to hear, but if you had a $5,000 account, you could probably make, not consistently, I'm not going to say like every single month you're going to pull out, 500 to 1,000, but over the year, that probably average, it would be 500 to 1,000 you could probably make, depending on, how much volatility you're taking. And that's still really decent, because I know many traders that are still, working a job and then trading on the side, and then they keep on growing their capital, and then that size grows and grows and grows, and then, all of a sudden, 2 years, 3 years down the road, they don't work anymore, or they take a very small part-time job, and then most of their income is coming from trading. And I think that's still a beautiful approach. And to some, I would say you don't even ever need to leave your job, because if you can get 2 streams of income and you can do it with your trading, it doesn't sacrifice any of your trading, then I think, like, why not? It's basically double compounding, at least in my opinion.
Yeah, there's someone that said like a job is the highest Sharpe strategy you can run. Yeah.
I love that. That's how I'm going to describe it from now on.
Yeah.
That's great.
You
That's so
can
good.
you can be terrible at it to the point that you don't get fired, of course, but you can be terrible and you still collect that cash at the end of the month. So
That's so good. I'm going to do a tweet about that. That's hilarious. That's so good. All right. What topic do you want to go on to next?
we could talk about automation and manual trading. I actually saw someone
Sure.
today, like a discussion on it, and I have some nuances about that. What is your opinion? Where would you apply like automation? What kind of strategies, and what kind of strategies would you say that is more valuable to do manually? I'm not saying the specifics of the strategies, but I would say just if you think there are nuances. For example, not everything has to be automated and not everything has to be manual, if that makes sense.
Yeah, I understand. I'll say it's very specific, normally to the strategy type, but as a general blanket statement, for most things, I think you have the advantage automating for consistency, at least in my opinion. I think execution is where you can lose the most of your edge, obviously. It's quite self-explanatory. So if you can automate a lot of those things to keep it very consistent, I think that's the benefit of it. The other side of it is that if you have the most easy example for me to pull on would be like people that say they can read order flow very well. While I never really got very good at it, I do know some people are decent at it, and they do add quite a lot of edge by being able to do that. So trying to automate that, there's just not really much pros to it. It's a pain in the head to do. It's very difficult to do. You don't even know if you could fully replicate that edge. So having that manual approach to it, is plus EV, at least in my opinion.
Yeah, no. I saw like a conversation around that, and there's definitely nuances. Like for most stuff that we talked about, like trend and stuff like that, maybe running an automation is fine. You could run it from an Excel, an hybrid, or even manually.
Yeah.
But I wouldn't be like, I can trade because it's not automated. Look, I've ran my model manually up until today. Like, I don't have an automated model running right now. It just manually traded, and there's nothing wrong with that, because I'm actually in the market while the geeks are talking about I have to automate, I have to consider everything. I'm in the market and they are not, so that's the difference. But for example, today I was also seeing someone talk about funding, like a funding strategy that he was running, and he was talking about that should be automated. And I'm like, what the hell? You can see that that person is not actually trading the opportunity, because you would know that these things don't last very long. If you get something like an edge that is paying you 2% an hour or 2% every 4 hours, which you can find in crypto, that stuff doesn't last for long. The time that it takes you to build automation, the edge is gone. So you have to go to the order books and just get the orders in and do the position. And I think there's nuances to this game. You can be automated, of course, and that's good. That's you can be more efficient with your automation, but don't let automation and like how can I say, complexity get in the way of you actually getting in the market and getting your opinions expressed.
Yeah, I would say it's kind of like a two-prong, maybe three-prong approach that I'm thinking about it in, is that like one, I think it's quite a benefit for you that obviously you're trading full time, so it means you can manually execute. You don't have that many signals, so there's not much of a downside to it. Whereas if you're working full time or something like that, then automation could fill that gap. So it's about like how relevant it is for you. If it's stopping you from executing or from consistent execution, I would say automation is there. Then the second part I'd say is what you just mentioned with that kind of like arbitrage. If there isn't enough time, or if it is not worth the headache, like how I like to put it, then yeah, don't automate it. There's no need to it. Like you could probably spend a whole year trying to automate some order flow thing, but I've tried sometimes and it's just never worth it. It's just better to have that trader use his many years of experience and do it himself. Whereas like more simplistic things, like let's say someone's trying to build out a portfolio and you're trying to manage like 7 strategies, then yeah, you have to automate. No one's manually executing 7 strategies at once. And the most important part about that statement is no one's probably doing manual execution of 7 strategies at a consistent execution on all of them. One of them is probably going to be degraded. Maybe you missed a signal here and there, and those are things that are very important, especially for strategies like trend following strategies. So that's kind of how I would think about it. So I think you summed it up quite well though.
Yeah, for sure. Completely agree. If you can like automate something that is those core strategies that we talked about that are more simpler, let's say not simple, but the core strategies, okay. But if you see an opportunity elsewhere that that is there for a short limited of time, get in the order books and extract it for yourself. You don't need to be fancy about it.
Yeah, completely agree. I also really like the one thing that's not as complex as full automation sometimes is just doing like alert systems. So sometimes like if I'm testing out a strategy, I'll just have it set up on like TradingView as an alert. It's not where I backtest the model or anything, but it's like coding up on PineScript takes like, I don't know, 5 minutes for me. It's like really quick and easy to use. So if I just want to get a general idea, then I can get an alert system up and running. It doesn't have to be full automation just yet.
Yeah.
All right, I guess let's go into a final topic, which is the specializing in a niche.
Yeah. In that regard, it's just my own thoughts on specialization or running a bunch of stuff together. I was hearing this podcast. I think it was with Rob Carver, and he was asked about what is better, to diversify across systems or across assets. And I thought that was a very interesting question, and probably should give us another hour for that. But it comes to a point where I don't think that you can be really good at everything, and you need to really focus on a few things that you are good at. And thinking that you're going to run mean reversion, trend, momentum, carry, seasonality, all of these things together without a team and just by yourself, I think it's a bit naive. And I think that people will do much well just focusing on a few things, not one, a few things, and then scaling that up to a bunch of different markets and different ideas. What do you think of it?
I think we might differ on it a bit. It's a very interesting question. You're completely correct. I probably could talk about it for a while, but I would agree you can't specialize in multiple different asset classes, or like a general example for me is like if I tried to be trading options, futures, equities, and crypto all at once, and it's just me, that's not going to work. Things are going to break. But for like strategy types, I'm not as opposed to being able to specialize in multiple. I don't think, at least many of the core strategy types aren't extremely complicated to at least get a version executing, if that makes sense. But I do agree that you can't specialize across so many when you're only singular. I think for me, like why I haven't expanded into, Well, it's actually why I decreased my trading volume small caps, because I was just so focused on futures, and then also I'm now been exploring crypto as well more. So like I just can't be trading all three. It's too much bandwidth. So I scaled down small caps, and now small caps is just basically fully automated with like a previous code that I was using, and then now I'm still really focused on futures, and then still exploring a bit of crypto, and like even that is a full-time job. So I do agree. You do have to pick a couple of your niches, maybe one or two, like max, probably.
Yeah. Uh, because then you start to understand everything about them. It's like a business. You start to understand what's their problems, what's their upside, how to manage it, and you'll find yourself with a full-time job in your hands once you are managing more and more capital and you start getting more sophisticated. So maybe it is good to specialize in a few things. So this is my view right now. Maybe in the future will change, but right now I run a few models. I run mainly one trend model, and I run a bunch of other stuff that are smaller. And I find myself with my time fully occupied. So that's where I stand today.
Yeah, I agree. Like, do you like the funding arbitrage? Is that like I would assume you classify that as a whole different niche compared to your normal stuff.
Oh yeah, completely
Okay, yeah.
different.
It's very hard. I don't know what you would necessarily call that, because it's obviously it's still crypto, but it's like I guess it's just a different niche. Yeah, I'd say then in general, if we're sort of thinking about that's what a niche is, then yeah, I think maybe
It's
two
probably
to
a
three
carry trade.
max.
Sorry to interrupt you. I just said it's probably a type of carry trade.
Yeah, I guess that's probably true. I never really go into carry trades that much.
Yeah.
It's a very sort of complex thing to fully execute on.
Yeah, it's just another strategy type. But yeah, it starts getting it gets a bit complex on the tails, let's say.